Investment markets were more volatile over the past quarter. The volatility was largely caused by shifting expectations around inflation and the path of interest rates, with flow-on impacts to share markets. The chart on screen helps tell the story. Here we show the yield on the US 2-year Treasury bond, the orange line, which is a good proxy for the future cash rate, against the MSCI World Share Market Index, the blue line. Higher than expected US inflation data in early April reignited concerns around sticky inflation and caused many investors to push back expectations of interest rate cuts. As a result, bond yields rose and share markets sold off across the board. This trend reversed abruptly in May as indicators of economic activity and inflation began to ease. These early signs of economic slowdown were well received by markets because they increased the probability of interest rate cuts. Against this backdrop, bond yields fell and share markets recovered, and in many countries, share markets reached all-time highs. Despite some scares in April, the second quarter provided further evidence of an orderly slowing of growth and inflation, providing scope for rate cuts and increasing the probability of an economic soft landing. In Australia, however, the story is a little less clear. There are some signs of economic weakness, but domestic inflation is remaining stubbornly high, giving the RBA less room to move. This divergence is shown in the graphs on screen. On the left is the market expectations of the US cash rate, showing a steady pace of interest rate cuts. In contrast, the market expects the RBA to keep rates at current levels for an extended period, with some potential for another hike later this year. Given the existing strains on the domestic consumer and the expectation that cash rates will remain elevated, there is a risk that the Australian economy slows more materially than the rest of the world. From a valuation perspective, the US share market looks elevated relative to history, but this needs to be viewed in the context of a significant increase in the quality of the companies that make up the US market today. Valuations in the Australian market also look elevated. This warrants a cautious and selective approach to both markets, in our view. Valuations elsewhere look much more reasonable, with Europe, Japan, and emerging markets all trading at or below long-term valuations. We also see attractive valuations in global small companies. In the bond portfolios, we retain allocations to government bonds for the attractive income they offer and as a hedge against a sharper economic slowdown. We also continue to like high-quality Australian corporate debt, which is currently delivering attractive yields for modest risk. Overall, we retain a cautiously optimistic outlook for the global economy, for investment markets, and for your portfolios.